What are the requirements for PMI removal? Have you ever wondered how to get rid of private mortgage insurance? If you made a down payment of less than 20% on your home, you might be paying for it. Let's break down the requirements for removing this insurance and how it can save you money. First off, the main requirement for removing private mortgage insurance is having at least 20% equity in your property. Equity is the difference between your home's current value and what you still owe on your mortgage. When your loan-to-value ratio reaches 80% or less, you can request to remove the insurance. Next, you need to submit a written request to your mortgage servicer. Federal law states that once you hit that 20% equity mark, you can ask for the insurance to be canceled. Your lender must comply if you meet all other conditions. Another important factor is your payment history. To qualify for removal, you must have a good payment record and be current on your mortgage payments. Lenders usually want to see that you have made all your payments on time without any recent late payments. Did you know that your lender must automatically terminate the private mortgage insurance when you reach 22% equity? This is based on the original purchase price of your home, and it happens as long as you are current on your payments. This automatic termination typically occurs when your loan-to-value ratio hits 78%. Sometimes, your lender may requiring a home appraisal or some form of value verification to ensure your property supports the equity claim. This is especially true if you are asking for removal based on an increase in market value rather than just paying down the loan. If you have made home improvements that increase your property value, you can request removal based on that as well. However, you still need to have at least 20% equity after those improvements. If you are relying on market appreciation alone, some lenders may requiring 25% equity before they approve your request. To speed up the process, consider making extra principal payments. This can help you reach that 20% equity threshold sooner, which is great for investors looking to reduce their monthly costs quickly. Keep in mind that rules can vary for investment properties. Some lenders may have stricter requirements or different timelines for removing private mortgage insurance on these types of properties compared to primary residences. Also, the type of mortgage insurance matters. Borrower-paid mortgage insurance can be removed following the guidelines we discussed. However, lender-paid mortgage insurance is built into your interest rate, and to eliminate this cost, refinancing is usually necessary. Lastly, some lenders allow for cancellation of private mortgage insurance after a set time, like 5 years, even if you have not reached 20% equity. This can vary by lender and loan terms, so it's wise to check with your mortgage servicer. For real estate investors, removing private mortgage insurance as soon as possible can improve cash flow by lowering monthly payments. Keep an eye on your loan balance and property value, maintain a strong payment history, and communicate with your mortgage servicer to initiate removal when eligible.